Make capital on investments. How Warren Buffett made a fortune investing in IPOs. Hello everyone, if you don't know what an IPO is and how to invest in it, I'll tell you now, and also talk about how to make capital in a few years and how Warren Buffett did it. IPO, initial public offering, is the process of initial public offering of shares of a private company on the open market. As part of the IPO, the company sells its shares in the financial markets for the first time to raise capital to finance its activities or to allow previous investors to withdraw from investments. When the company decided to conduct an IPO, it works with financial institutions such as investment banks, which help it prepare for the placement of shares and make a sale on the open market. Financial analysis, legal support, documentation and registration procedures are usually included in the preparation. During an IPO, the company determines the price of shares at which they will be sold and offers them to potential investors. However, the placement process itself may contain risks and conditions related to changes in the share price and the need for financial transparency of the company. Investors buying shares in an IPO can expect to profit from the growth in the value of the company's shares in the future. For investors, investing in an IPO can be a way to gain access to shares of a company that was previously unavailable on the open market. However, such investments carry certain risks, and potential investors should conduct a detailed study of the company and make an informed decision about investing funds. In many cases, Warren Buffett has not shown much interest in participating in initial public offerings, IPOs, of companies. He tends to choose stable companies with good financial performance and a solid business model. When a company has already gone through an IPO and has a proven business track record, Buffett may consider investing in it. However, there are several cases where Berkshire Hathaway, Buffett's investment management company, acquired shares of companies during or immediately after their IPO. For example, Goldman Sachs. During the 2008 financial crisis, Goldman Sachs needed capital, and Berkshire Hathaway invested $5 billion in Goldman Sachs priority shares through a private placement. It wasn't a typical IPO, but Berkshire Hathaway supported the company through difficult times. General Motors. In 2010, Berkshire Hathaway acquired shares of General Motors during the company's IPO after the automaker went through bankruptcy proceedings. Burlington Northern Santa Fe. In 2009, Berkshire Hathaway acquired the remaining shares of Burlington Northern Santa Fe Railway Company after already owning a significant stake. It was not an IPO, but Berkshire Hathaway used this opportunity to become the sole shareholder of the company. In general, Warren Buffett prefers to invest in established companies with a solid business model, and he treats IPOs of companies with a certain skepticism. However, in some cases, he may consider investing in shares of companies after they go through the IPO procedure. The initial public offerings (IPO) market is a dynamic and fluctuating market. Despite the fact that IPOs can provide opportunities for rapid growth and capitalization of a company, they also involve certain risks. The stability of the IPO market depends on various factors such as the economic situation, investor interest and market sentiment. During a good market period with moderate demand for new stocks and a sufficient investment climate, the IPO market can be relatively stable. In such circumstances, companies can attract investments quite successfully, and shares can show steady. However, during periods of economic instability, market crashes, or financial crises, the IPO market may be less stable. Investors are becoming more cautious and may be less willing to invest in new companies, which may make it difficult to raise funds through an IPO. It is also worth noting that the stability of the IPO market may vary in different countries and regions, depending on specific factors and trends in these regions. In general, the IPO market can be both stable and volatile, and its stability depends on many factors that affect the investment climate at a given time. Here are some tips to help you choose the right IPO to invest in. Explore the company. Explore the financial performance, business model, products or services, competitive position of the company and its strategy. Analyze her past financial statements and future prospects. Evaluate the attractiveness of the industry. Study the industry in which the company operates. Evaluate its growing or fading trend, the potential for innovation, and the risks associated with industry factors. Analyze the competition. Study the company's competitors and their market share. Evaluate the uniqueness of the company's products and its ability to compete in the industry. Explore the management team. Attach importance to the experience, qualifications, and reputation of the company's executives. Their ability to implement the strategy and achieve the set goals is essential for the success of the IPO. Pay attention to the pricing policy. Research the offered share price in the IPO and compare it with similar companies in the market. Evaluate how fair the price is and whether it is related to the financial performance and prospects of the company. Read analytical reports and research. Study the opinions of financial analysts about the company and its IPO. They can provide additional insights and arguments for making an informed decision. Consider the risk and potential return. Assess the risks associated with investing in an IPO, including possible fluctuations in stock prices. Compare the potential return with other investment opportunities available to you. Consult with a financial advisor. If you have doubts or uncertainty about the choice, seek advice from a financial advisor who will help you understand the details and assess potential risks. It is important to remember that investing in an IPO involves certain risks. Before making a final decision, be sure to conduct your own risk analysis and assessment and consult with qualified professionals if you doubt your abilities. The highest return from an IPO. Alibaba Group holding limited shares have been in history. Alibaba is the largest Chinese company specializing in e-commerce, internet technologies, and artificial intelligence. Alibaba held its IPO on September 19, 2014, on the New York Stock Exchange, at a stock price 68. As a result of the successful placement, the value of the shares increased significantly, and at the end of the first day of trading, they reached a price of about 93. This meant that the return of investors who purchased Alibaba shares at the IPO price was about 37% in one day. Subsequently, Alibaba's shares continued to grow, and at their peak, they reached a price of more than $200. Playing on the price difference on the first day of the IPO and in the period of subsequent growth is the basis for high returns for investors who were able to purchase shares at the IPO price. However, it should be noted that the profitability of an IPO can vary greatly depending on the markets and time. The chances of a high return on an IPO depend on various factors, including the supply of shares, demand for them, the company's valuation, and the state of the market as a whole. It is also important to keep in mind that past results do not guarantee future profitability. IPOs also have risks and disadvantages. Conducting an IPO can be a complex process and involves certain risks, including loss of control over the company, reduced confidentiality of information, additional costs and reporting requirements, as well as the possibility of disappointing investors if the company does not achieve the expected results. In general, an IPO is an important event for a company that requires preparation, discussion with professionals, and careful study of all the advantages and risks. It can be an effective tool for attracting investments and developing a company at a new stage of its development. Many investors have made large profits by investing in IPOs. Some notable examples of successful IPO investments include Jeff Bezos and his investments in Amazon. When Amazon launched its IPO in 1997, the shares were only worth about $1 apiece. Since then, the stock price has risen significantly, and Bezos has become one of the richest people in the world. Warren Buffett and his IPO investments. Buffett, a well-known American investor and entrepreneur, has had success investing in many companies after their IPO. Some of his successful IPO investments include Coca-Cola and Visa. Peter Thiel and his investments in PayPal. Thiel is a well-known venture capitalist and, together with Elon Musk, had a great influence on the development of PayPal. Thiel invested in the company at an early stage and made significant profits after the IPO. Elon Musk and his investments in Tesla. Musk is one of the founders and chief technical officer of Tesla. His investments and work on the development of this company led to a significant increase in the share price after its IPO. It is important to note that investing in an IPO has its risks, and not all investors succeed. The results of investments depend on many factors, including the state of the market, the financial stability of the company, and the correctness of the investment assessment. Before making a decision to invest in an IPO, it is recommended to conduct a thorough study and consult with a professional financial advisor. Subscribing to the Finance channel is a great way to stay up to date with the latest news, trends, and strategies in the financial world. Nowadays, when financial literacy is a key element of success, subscribing to my channel can be an invaluable investment in your knowledge and skills. Be sure to share